Hi, Larry Gaines, PowerCycleTrading.com. In this video, I want to show you one of my very favorite option strategies. It's what we call the calendar diagonal spread. So it's kind of similar to a covered call, and some people call it a poor man's covered call. But I'm going to walk you through how the trade works, and I'm going to show you based on an example of one that we did on Apple. So this is an Apple calendar diagonal spread, and then I'll show you a current one with Microsoft. So let's take a look. So first off, I found this a really great strategy when you've had typically a really good sell-off, and you've got whatever security you're looking at starts to bottom out. And typically what happens though, a lot of times when you start to bottom, it doesn't take straight off. It could kind of pull back and field and consolidate. So as you're waiting for it to consolidate and then take the directional pop either up or down, whatever your bias is, this helps you to stay with the trade because it's kind of like a covered call. So what we can do is we're going to be long, instead of being long stock shares, we're going to be long a long dated option, and then we're going to sell a closer dated option against it. So as it consolidates sideways, we're collecting theta, time decay, and volatility going collapse, and we can have that discount and pay for the long dated call. So here's an example of Apple. So Apple was starting to turn up, but we thought it could pull back and take some time to take off. So we wanted to have a strategy where we could stay with the trade. We didn't have to be exact on the timing of the breakout, and we could roll it if we needed to. So let's walk through this trade. So in this original trade on Apple, so let's walk through this trade. So this is going to be going long the 15 March 165 call. Okay, so at that point in time, Apple was trading right around 165. Let me back up to the chart. So you can see Apple was trading right around 164, 165 right here. So we were looking for kind of a target up to, this 170 area right in here. All right, so you could think of this like buying a call, call debit spread. So buying the 165 call, maybe selling the 170. But instead of doing it in the same series, we're going to do this as a calendar. So calendar diagonal. So we're going to buy the long dated further out in time and then sell the short dated 170 closer in as far as time goes. So we bought the 15 March 165 call, paid $645. That would be per option contract. And then instead of selling the March 15 170 call, we sold the 15 February 170 call, brought in $1.88 or $188. So we have a debit cost, total cost, maximum risk $457. Now you can see there on the 15th, now it was trading, Apple's trading at 170.42. So from this calendar spread, we had a gain of $253. So it went from this, price of $457. We had an increase in that spread, and the spread went up where we had a total profit per spread of $253, which on the risk of $457 gave us a 55% return on our risk. But the other great part of the strategy is that if you decide you want to see a little bit more directional push and you want to take advantage of it, we can adjust the trade to put us in a position where we can take a bigger move or take a bigger slice of the pie to the upside in this situation. So what we did, we had on the 31st, we'd sold the 15 Feb 170 call short, and remember we were long the 15 March 165 call, so we're in at 457. Now on the 15th of Feb, the 170 short call now had gone down in value. It was originally sold at $1.88 short strike, and now it was trading at 40 cents. So we bought it back at 40 cents. That gave us a profit on the short strike of the 170 of $1.48 or $148. Now what that does for you is it adjusts down the long dated 165 call from 645 to 497, and then we could have just stayed long that, let it run if we thought it was going to go up. Or what we did on this trade, we went ahead and rolled out and we sold the March 1 series 175 call, so $5 higher, brought in $1.05. So now we had adjusted calendar debit at 392, and you can see on the 22nd it went to 415, now up 105%. So a great way to increase it. Now I'll show you one that we currently have on where we started out with a calendar diagonal and then converted it to a call debit spread, and this is on Microsoft. So this is a calendar diagonal that we originally set up on Microsoft right here on the 25th of September. So we were looking for Microsoft to make a move up over this 382. Didn't realize it would have this big a move, but I'll show you how we adjusted the trade to put us in a position for capturing this bigger breakout with starting out with a very defined risk calendar diagonal. So let's walk through this trade real quick. So we originally had bought the 16 October 205 call. This was back on the 25th of September, and then we sold the 2 October against the 210. So we had a $5 wide spread. Okay, so we set that up. Now the 210 strike expired worthless, so we kept that full premium, and that adjusted down our 205 call to the next level, which was adjusted down to the cost base basis of, let me show you that. Let me scroll down. So we then adjusted that 205 from the profit we took on the short strike 210 to a cost of 495. And then we immediately also sold the 9 October 210 against that for a good premium. Now that one expired and we took the profit on that one, which then put us into adjusted trade here. Final adjustment was long the 16 October 205 call with the adjusted price of 390. And then what we did was turned around and we sold and converted this into a call debit spread. And we did this last Thursday and sold the 212.5 16 October. So now it's in the same series for 211. So now we're into a call debit spread for $1.79, and it went out today at 7.18. So this has potential for a huge profit to the upside. So again, just kind of a short review. So on last Thursday, that was the 8th of October, we closed out the short, the 9 October 210 short, took profit on that, and then turned around and sold the 16 October 212.5 at $2.11. So that puts us into a call debit spread with the adjusted price here of $1.79. All right, so we're long the 205 212.5, nice wide spread there, and we've got a total cost basis or risk of $179. And this Friday, if it closed, all it has to do is close over 212. It went out today at 220. This is a $571 per spread profit on the risk of 179. That'd be a 318% return. So this is a great strategy because there's so many different ways that we can adjust and convert it and do a lot of different things. So if you'd like to learn more about this type of option trading strategies using options, I do all kinds of different strategies using option spreads. Make sure to come check us out at powercycletrading.com. Use the link on this video or on this newsletter. Good luck trading.